Structured secondaries, I would call quasi-debt. The use of NAV facilities and structured, these are tools that have emerged in a major way, I'd say, in the last 5 years. So they're probably the newest and most kind of innovative side of the market. NAV lending, the way it's used, has changed kind of significantly. Up until COVID, they were used more for DPI acceleration. A $500 million fund, you take $100 million of debt, essentially, to give back to your LPs, which has now become a very controversial way of using. We can go into why, but is.
Did you say that the banks sometimes lend to NAV lenders at the fund level?
Yeah.
Wouldn't that make it leverage on leverage on leverage?
Well, the way it would work, yeah, basically, yes. But in venture, 80% of the liquidity is in 20 names. When you see pricing data, for example, what people are really talking about is Revolut. They're talking about SpaceX or whatever it is. If you're holding a very solid European company that's subscale and minority stake, there's almost no liquidity in that. But sometimes you just want liquidity quickly, you like your portfolio, or you just completely disagree with the pricing. That's where you might want to look to a NAV loan, a structured secondary.
NAV, the manager's mark, is the reference point in all this. But how robust is this? And let's say you as a NAV lender, you must take a pretty sharp view of this. What's the best practice in terms of analyzing it?
We're holding something at the last funding round. So, well, that last funding round was in 2021. So, probably you should, there's no obligation necessarily to kind of mark that down. You're telling me that company X is worth $1 billion. I've just gone and spoken to an intermediary and they've said that they just sold this for whatever, a valuation of 600 million. So in my mind, I'm marking it at 600 million. As a NAV lender, what tends to happen, if you're too far out on the NAV, you just do not do the deal. Like NAV is not cash in the bank. You have to do your own work. You buy and sell out of NAV as an evergreen structure. They tend to have 5% available, say, on a quarterly basis, which is fine as long as there's significant inflows or not very many outflows.
But that is all you get, though, isn't it? It's the headlines. It's not a run on the bank because the mechanism is there.
Exactly.
And so it's really an optics thing. It's an education thing. It's not a structural thing.
But what I would say, all of the headlines, I think, are extremely misleading at the moment. I think the asset liability mismatch of certain vehicles and the gates and this and that is being conflated with a systematic problem in private credit.